Welcome to our financial podcast, where today we'll be unpacking the very foundations of personal finance. To start, can you share what core principles everyone should master before diving into more complex strategies?
Absolutely. At the heart of personal finance are budgeting, saving, and understanding your cash flow. Think of it like building a house without a solid foundation. Even the fanciest investment strategies can crumble. Tracking income versus expenses is step one.
That's a great analogy. Many listeners struggle with consistency. Are there tools or habits that make tracking finances less overwhelming and more sustainable?
Definitely. Digital budgeting apps like YNAB or Mint automate much of the process, but even simple spreadsheets work wonders. The key is to treat it as a regular check-in, like brushing your teeth habitual, not optional.
So it becomes a part of your routine. Before we move on, is there a common mistake people make at this stage that you'd warn them about?
Many people underestimate small expenses. The latte factor, those daily coffees, can add up to over $10 a year. Awareness is your first defense against lifestyle creep.
Once the basics are in place, the next step is setting clear goals. How important is specificity when it comes to financial goal setting?
It's crucial. Vague goals like save more rarely lead to results. Instead, set SMART goals: specific, measurable, achievable, relevant, and time-bound. For example, save $50 for an emergency fund within 12 months. Gives you a target and a timeline.
That makes sense. Sometimes people feel overwhelmed by big numbers. Is it better to set smaller milestones along the way?
Absolutely. Breaking a large goal into monthly or even weekly targets makes progress feel tangible. Celebrating small wins along the way boosts motivation and builds financial confidence.
In your experience, what's a common pitfall people face when pursuing financial goals?
Many people don't adjust their goals as circumstances change. Flexibility is vital. If you get a raise or face an unexpected expense, revisit your plan. Financial journeys are rarely linear.
Let's transition into an often misunderstood topic: credit scores. Why do credit scores matter so much? And what really impacts them?
Your credit score is your financial reputation. Lenders, landlords, even some employers use it to gauge reliability. Payment history makes up 35% of your score, so paying bills on time is non-negotiable. The amount you owe and your credit mix also factor in.
Many listeners worry about checking their credit reports. Does checking your own score hurt it?
That's a common myth. Soft inquiries, like checking your own score, have zero impact. Only hard inquiries when you apply for new credit can cause a slight, temporary dip. Regularly reviewing your reports actually helps spot fraud early.
Suppose someone finds an error on their report. What's the best course of action?
Dispute it immediately with all three major credit bureaus. According to a 2021 FTC study, about 1 in 5 consumers had an error, so vigilance pays off.
A crucial pillar of stability is the emergency fund. Why is it so often recommended, and how much is enough?
An emergency fund acts as a financial shock absorber. Experts suggest 3 to 6 months' worth of living expenses, but even $10 can cushion unexpected car repairs or medical costs. The pandemic underscored the importance of having accessible cash reserves.
Some argue that tying up money in a low-interest account isn't optimal. What's your response to that?
It's a valid concern, but liquidity outweighs returns here. Imagine your furnace breaks down in winter. Waiting days to sell investments isn't practical. Think of it as paying for peace of mind, not maximizing growth.
For those starting from scratch, what's a realistic way to build an emergency fund?
Automate small transfers each payday. Even 20 a week adds up over time. The key is consistency, not perfection.
Debt can feel overwhelming, but there are proven strategies to tackle it. Could you walk us through some effective approaches?
Two popular methods are the avalanche and snowball approaches. The avalanche targets highest interest debt first, saving money in the long run. The snowball pays off the smallest balances first, providing quick wins and momentum.
How do you recommend choosing between these methods?
It depends on your personality. If you're motivated by numbers, avalanche is logical. If you need psychological boosts, snowball might be better. A 2020 Harvard Business Review study found that people who saw early progress stuck with their plans longer.
What about debt consolidation? When does that make sense?
Debt consolidation can lower interest rates and simplify payments, but watch out for fees. It's best for those with good credit and a solid repayment plan.
Moving from debt to growth. Let's talk about investing. Why is consistency often cited as the key to building wealth?
Consistency leverages the power of compound interest. Think of it like planting seeds in a garden. Regular contributions, even small ones, grow exponentially over decades. Dollar cost averaging smooths out market volatility, reducing risk.
For new investors, the sheer variety of choices can be overwhelming. Where should someone start?
Index funds and ETFs are excellent starting points. They offer broad diversification and low fees. According to S&P's 2023 report, over 85% of active fund managers underperformed the S&P 500 over 10 years.
What about timing the market? Should people wait for the perfect moment to invest?
Timing the market is notoriously difficult. A Fidelity study showed that missing the 10 best days in the market over 20 years can halve your returns. Time in the market beats timing the market.
Retirement planning is a concern for many, especially those who feel behind. How big of an advantage does starting early offer?
Starting early is like giving your investments a head start in a marathon. If you begin at 25, saving $200 a month at 7% annual return, you'll have over $500 by 65. Wait until 40, and you'd need to save 3 times as much to catch up.
For those who are starting late, what are some ways to accelerate retirement savings?
Max out tax-advantaged accounts like 401ks and IRAs, catch up contributions if over 50, and consider delaying retirement to boost Social Security benefits. Downsizing or part-time work can also help bridge the gap.
Are there psychological barriers that prevent people from taking action on retirement?
Absolutely. Present bias makes it hard to prioritize future needs over current wants. Visualization exercises like imagining your retirement lifestyle can turn the abstract into something motivating.
As we build wealth, protecting it becomes vital. Can you explain the primary types of insurance everyone should consider?
At a minimum, health, auto, and renters or homeowners insurance are essential. Life insurance is crucial if you have dependents. Disability insurance is often overlooked, but statistically, 1 in 4 workers will face a disability before retirement.
Some people feel insurance is an unnecessary expense, especially when budgets are tight. How would you address that skepticism?
Insurance is like a seatbelt. Hopefully you won't need it, but it's invaluable in a crisis. Medical debt is the leading cause of bankruptcy in the U.S. The right coverage can prevent financial ruin.
What's your advice for determining the appropriate coverage levels?
Assess your assets, liabilities, and family needs annually. Online calculators and consultations with independent agents can help tailor policies to your unique situation.
Life is full of transitions: marriage, parenthood, career changes. How should people adjust their financial strategies during these milestones?
Each transition is a chance to revisit your financial plan. For example, after marriage, you might consolidate accounts or update beneficiaries. New parents should revisit their wills and consider college savings plans. Flexibility is key.
What about unexpected changes, such as job loss or illness? How can listeners prepare for those?
This is where emergency funds and insurance shine. Additionally, upskilling, taking online courses, or networking can make job transitions smoother. Planning for the unexpected makes setbacks less devastating.
Can you share a real-world example of someone who navigated a major life change successfully?
A client once faced sudden divorce. Because she had maintained her own credit and emergency savings, she was able to relocate and restart her career with minimal disruption. Preparation breeds resilience.
As we wrap up, let's talk about mindset. How does one cultivate a healthy relationship with money that endures through ups and downs?
A wealth mindset is rooted in intentionality and gratitude. Focus on long-term goals, practice mindful spending, and avoid comparison traps. Studies show that those who track progress and celebrate milestones are 42% more likely to achieve financial goals.
That's inspiring. How can listeners turn financial setbacks into growth opportunities rather than discouragement?
View setbacks as data, not defeat. Analyze what went wrong, adjust your plan, and remember that progress isn't always linear. Surrounding yourself with supportive communities, online forums, or accountability partners can make all the difference.
What's one actionable practice you recommend for developing positive financial habits?
Schedule a monthly money date with yourself to review goals and celebrate wins. Reflection builds self-awareness, which is the cornerstone of lasting financial well-being.